BlackRock just did a massive deal buying infrastructure firm GIP for $12.5 billion. And as Ben said, Larry Fink has called it transformational, so have you. Can you talk a little bit more about that? What does this deal do for BlackRock, and what does the new BlackRock transformed by GIP look like?
Thank you. Thanks, everybody. I hope you've had a great day. At BlackRock, we've tried to be excellent stewards of capital and organically investing in our business. But we've also really challenged ourselves through our corporate planning process, with our board, with all our stakeholders, to just constantly be looking out 10 years. How are clients investing? How are portfolios going to change? Where are global flows of capital going? Where are supply-demand imbalances in the world? And we've made a lot of calls, I think, on the shape of our industry. So we did a big transaction in 2006 that took BlackRock from being largely a US-centric fixed income firm, turned us into a global equities firm, a global distribution firm. We made some calls on the industry around indexing and the blending of active management and index management in whole portfolios with the acquisition of Barclays and iShares back in 2009. And when we've looked out on the industry and the growth of private markets and portfolios, we really think private infrastructure is going to be one of the fastest growing categories and fetching what we think are outsized allocations in client portfolios. By all accounts, we expect what is today about $1 trillion of private infrastructure to be $2.5 trillion of private infrastructure going out to 2027, $30 billion of revenue. In all our client surveys, what we hear from our clients is the top two categories for future allocations are going to be private debt and private infrastructure. So we see the client trends. And then finally, there's just this enormous infrastructure spend gap in the world. The G20 forecasts are for $75 trillion of infrastructure spending that needs to happen for global growth and for global well-being. We think that governments alone are not going to be able to do that, and there's going to be really attractive opportunities for private capital. So that really fueled finding a partner. We've been building our infrastructure business organically. We built a $50 billion infrastructure business at BlackRock. But we wanted to build and integrate with a firm that we think has great operational excellence in infrastructure, and Global Infrastructure Partners really fit that category. It really transforms our capabilities in the infrastructure investing space. We moved from being a $50 billion player to being a $150 billion player, number 2 on the league table. We moved from being predominantly a mid-size, mid-cap investment grade player to being able to have capabilities all across the infrastructure spectrum. And then finally, GIP has really distinguished itself by having a 50-person business improvement team that sends 3 or 4 executives. Think of these people as former Honeywell, GE, American Airlines type executives to come in and improve the operational quality and value creation of an asset. So we're really excited. This takes us from $160 billion of illiquid assets to close to $300 billion of illiquid assets and a real fast grower for our organic growth, which we think is great for our shareholders.
Are there more deals like this on the horizon for BlackRock? Is this this big push into alternatives going to continue with other types of firms?
Yeah. So number one, we're focused on closing and integrating the GIP acquisition with excellence. We have a really good track record of integrating infrastructure businesses into BlackRock, which we've done for the last 10 years. We no doubt will continue to use inorganic as an important part of our strategy. We've been super consistent on all our earnings calls talking about private markets, technology, and regional plays as an area for inorganic focus. I think we'll be prudent in how we do that, in that this is a really important and transformational opportunity for us that will accelerate growth in the private markets. So we're going to focus on getting this one right. But as you know, M&A doesn't start, you don't turn it on and off, right? I mean, you're always working on ideas. You're always building relationships. In our corporate planning process, I like to do this thing where we look out 10 years, we have a strategy for 3 years, and we have a budget for 1 year. But that 10-3-1, that's our cycle. And in that 10, we're always thinking about what are markets we need to get into, how do we get into them? Are we going to build it? Are we going to buy it? Are we going to partner? And that really drives, I think, a lot of the inorganic thinking.
I was watching an interview that you did a few years ago, and you were talking about the... No, don't worry. It was good.
It was excellent, right?
It was excellent. You're talking about the products of yesteryear and how they wouldn't, be they weren't the products of the day, and they won't be the products of the future. So thinking about what BlackRock's doing with infrastructure and alternatives, can you talk a little bit about how that translates into how you how you invest on behalf of your clients.
Yeah, so infrastructure is just underrepresented, I think, broadly in portfolios around the world. Think of infrastructure as an asset that tends to do well in a lower growth and higher inflation environment. Infrastructure has a strong track record of diversifying portfolios. But what I'll say is it just hasn't been the most easy to access when you think about retirement portfolios, when you think about traditional financial advisor and wealth management markets. We think there are great reasons to include infrastructure in retirement assets. If you have a long-dated portfolio with a 30-year liability and a 30-year payout, infrastructure assets are current cash flowing, relatively inflation protected, diversifying. So we see great opportunities to take a lot of the thinking and acumen at BlackRock on product structuring and being able to take some of the infrastructure capabilities and assets and deliver them into these underserved markets like retirement portfolios. For example, in the UK and on the continent in Europe, they have these structures that are retirement portfolio friendly. They're called the LTIF and LTAF. And those are great places, I think, where we can bring infrastructure investing to portfolios that are underserved today.
So your big infrastructure push comes at an interesting time. You know, this obviously, and the Journal did a story the other day about the push into investing directly in the energy transition, and that comes as and I know you've all heard about this earlier today, the backlash to the traditional ESG approach. That's been tough for BlackRock. Can you talk a little bit about how BlackRock's navigated that?
Sure. We are a fiduciary fee-for-services firm. Clients give us directions, they give us guidelines, and we manufacture those portfolios, we operate those portfolios consistent with their guidelines and objectives. I think we're a market leader at delivering portfolios that are required to give people exposure to large cap growth or large cap value or international or emerging markets or minimum volatility or dividends, or for clients that say I have a specific objective about the CO2 score, about the controversy score, about the MSCI sustainability score. Clients are really in the golden age of being able to customize and personalize portfolios in the way they want. And if you travel the world, the clients are a bit like snowflakes in terms of the specific goals and objectives they have. They have goals and objectives that might be around income, around principal preservation, around sustainability. We're in the business of serving those goals with excellence. And so we've seen excellent momentum in doing that. The transition, meaning investing in tools and technology and infrastructure that will serve the low carbon economy, that has been one of the, I think, fastest growing sectors in the economy. And whether that's electric vehicle charging stations or whether that's carbon capture, there are huge opportunities for private capital in this space. And I'd say is all over the world, you're seeing great velocity, not just in the fundraising, but also in the capital deployment. And I'd say what's most interesting about it, we recently did a transaction with Occidental for carbon capture. What's really interesting is that CFOs and CEOs are using these transactions, particularly around transition investing, to turn to find ways of turning OpEx into CapEx or vice versa, and gaining a lot of financial flexibility in terms of how they manage the business by partnering with private capital to take assets that might not be core to their business, but are important to obviously their commercial success. And so I think this is only in the first inning, and it's just an incredible place for our clients, an incredible place for our corporate partners, and I think you're going to see a whole lot more of it. In the story, for example, that you wrote, you talked about kind of ESG and as an umbrella term. I'd say investing in the low carbon economy and in energy independence and transition is a really specific use, predominantly in the private markets, that I think is going to be fueled not just by risk return, but also by incredibly favorable policy. So if you think about the Inflation Reduction Act, if you think about the CHIPS Act, the Infrastructure Act, those things are creating environments that increase the rates of return on these portfolios and are drawing in private capital with great speed.
So have you seen a big shift in client interest away from the sort of the traditional ESG or that approach, that big picture approach, to the more specific transition funding?
It's not a monolith, right? So ESG or sustainability are umbrella terms to describe a whole array of strategies that clients are using. So if you go to Europe, there are very specific ESG strategies tied to regulation and disclosure. If you go to a Canadian pension plan, they have a very specific set of metrics in Ontario about carbon capture and controversy scores. So I'd say it's not a monolith. And again, it's sort of the golden era around data for clients to be able to customize their portfolios. But what I'd say is, if you look at the category of ESG funds, like at BlackRock, we had $200 billion of ESG assets in dedicated ESG strategies only 5 years ago. That's about $800 billion today. It's a category in the industry that's continued to experience positive growth, even against pockets of decay in the industry. So I think this is all about where clients want to allocate capital and against their benchmarks and objectives. So we continue to see good velocity in that part of the business. But ESG as a term is more of an umbrella term. Clients are specifically deploying it against, it might be transition to the low carbon economy, it might be an MSCI controversy score or Sustainalytics score. Clients are optimizing around mostly these data sets they're using to measure outcomes across sustainability.
So BlackRock is obviously an owner of many thousands of companies, and that on behalf of passive investors, and that massive voting power has been a big source of some of the angst around this for the firm. BlackRock's made a big push to get passive investors to vote their own shares. How's that going? What are the hurdles to getting more power back in the hands of the investors?
Yeah, sure. So today we are among several large companies that run passive and index portfolios all across the world, and we really value and take very seriously the responsibility of managing our clients' money and in how we engage with companies. I think many of the CFOs in this room and their IR departments would tell you that they have really positive engagements with BlackRock Stewardship Department that are all about long-term value creation. What I mean by that is the strategies that management teams have, the policies that they have, their performance that generate capital appreciation, dividend growth, and steady earnings. Like, that's the objective of all the stewardship teams at BlackRock, and I think our track record in that regard is very strong. What I'd offer is that kind of 99% of the things that people vote on in proxies pertain to like the appointment of the auditors. And so routine matters are the lion's share of the things that happen. The things that attract a lot of discussion are shareholder proposals.
What percentage would you say that is?
99%.
Oh,
99% of the things that people vote on are routine matters, like the board of directors, confirming the board of directors and the appointment of board of directors, confirming the public accountants for your financial statements. And so it's a very small number. When you look at the aggregate amount of voting that happens, it's a very small number of shareholder proposals that generate a great deal of interest. And this is not a new phenomenon. It's one that's, I think, goes through, has a sort of cyclicality to it of interest. But you can go back 20 years, 30 years, 40 years, 50 years. I remember when I was a little kid, my father was an executive at Citibank, and my father took me to the annual meeting. Yes, that was something my father did to me. And he took me to the annual meeting, and I sat next to this woman who passed away a number of years ago. Many of you probably know her. Her name was Evelyn Y. Davis. And Evelyn Y. Davis owned, you're nodding, right? Evelyn Y. Davis, I sat next to her. And she had, she owned a handful of shares in a whole array of public companies, and she went to a lot of meetings and made shareholder proposals that were everything about exiting certain markets, certain disclosure. It's not new. It's not new. This has been going on for many years. It attracts more attention and less attention over cycles, I think, based on different folks who are involved. What I'd offer is there is a reason that proxy voting has been put in the hands of professional asset managers. And I think it's mostly that actually it's very labor intensive. It requires a lot of work. It requires a lot of data. We have 50 plus people who do it at BlackRock. We're a member of every standard setting board that is out there. We take a lot of time to engage with companies productively. If you, in your portfolio, owned every stock in the US stock market, let's say that you had the total stock market index and you had 3,000 companies, like, you are not going to do due diligence on 3,000 companies. You are not going to go to 3,000 AGMs. You are not going to read 3,000 proxy statements. you are not going to have an idea of what the best practices are in how you cast your vote on, say, on pay. And so what the index managers, I would argue, have become is they've really become an agent of scale and excellence for otherwise investors that would exercise rational apathy. And that's mostly true. That's mostly true. If you look at retail investor proxy rates, they're like less than a third of retail investors vote their shares, whereas close to 90+% of institutions vote their shares. So I'd argue over long periods of time, if we just stick to the facts and evidence, I think corporate governance engagement with shareholder engagement is in a better place as a result of having more professional stewards of capital involved. But all that said, our number one view is clients should have total choice and total access about how they want to exercise their bundle of shareholder rights, which includes the ability to sell a stock, buy a stock, vote a stock, whatever it might be. And so what we've tried to do is using technology is put more of those votes and that opportunity in the hands of our clients. Today we have hundreds of billions of dollars at BlackRock with institutions, like 60 million kind of pension plan end participants who at the end of the day have the ability through their systems to vote shares through our institutional voting choice programs. And then we've most recently opened our largest exchange-traded fund, our S&P 500 fund, IVV, which is about 50% or so retail investors, to a pilot program in order to allow them to pick proxy voting policies that best match their desired outcomes for how shareholders vote. And even doing all these things, and lots of the other managers are doing them too, my prediction is that they will be given the option and that they will still prefer that professional managers vote on their behalf. And again, because I think it has to do with scale. It has to do with expertise. It has to do with acumen. And so I hope, and I think we live this every day with our clients, if they don't like the business they're doing with us, we run open-end funds they can redeem and they can go somewhere else. They've stayed with us. We've had $1.9 trillion of organic growth over the last 3 years. We've had $600 billion in the last 2 years. We had $300 billion last year. We had $100 billion in the fourth quarter. Over half of them are in the United States. And so I think every day, we live this with our clients about whether they're happy with the services that we provide them. And we're going to continue to work really hard every day to make sure that's the case. But being able to deliver them choice and technology that gives them scale in voting their proxies, we think the program's been very well received.
Let's talk about the economy for a minute. As I said earlier, BlackRock has stakes in many thousands of companies, which gives you a pretty unique vantage point into what's going on out there. What are you seeing? What are the issues you're hearing about from these companies?
So it's a character building and awe-inspiring time. I think to be a CFO and to be running a company, we finished 15 years of a very easy monetary policy and had a jarring unwind over 2022 and 2023. And I think what's most sort of common, I think, in what we see with many of the companies with which we engage is just there's less financial flexibility than you had, I think, in the world of low rates. And therefore, you have to, I think, particularly as a CFO, be even more picky about capital allocation and concentrating your investments against the things you believe will create the highest levels of growth or efficiency. And I think when markets are good, when financial conditions are easy, as CFOs, we can have a higher risk tolerance in how we allocate capital to different businesses. And when financial conditions are tighter, we have to be more picky about the expected returns that we're trying to generate. And I think it's pretty much common across all the industries that I see. I'd say BlackRock, asset managers, financial institutions, we tend to be more asset sensitive, which is different than some industrials. But broadly speaking, I'd say the thing that we see most with our companies is just there's less financial flexibility, but there's also terrific opportunity. The new issue investment grade market is on pace for, I think it's the biggest record that we've ever seen, about $500 billion of issuance, in the first quarter, and versus about 470, I think, is a prior record. At BlackRock yesterday, we placed $3 billion of financing. Our book was 5 times oversubscribed. We printed, the tightest 5s, 10s, and 30s. It's the first 30 we've ever done. We printed our 10-year at a spread of 87.5. To give you some context, last year we printed our 10-year at like plus 130. So I'd say like even though there's something to be said about rates are higher, yield curves kind of inverted, I actually think private capital, the public markets, they're seeing I think the end of what has been this jarring unwind of monetary policy, and you can feel green shoots of re-risking. And I think that's really good for everybody's business here. It's really good for global growth. It's really good for global well-being.
So last question before we take some questions from the audience. Larry Fink had told the Journal, the story we did not that long ago, that preparing BlackRock for the next generation of leaders was his number one priority. You're on the short list for that, but also on the team of people. We reported that you were on the short list.
You reported that I was. It was great.
But we also
not awkward at all with your colleagues. Yeah.
There's a team of people. The story was about how there's a team that is coming up.
I like that framing better. Yeah.
What the question I want to ask you is not if you're going to be the next CEO of BlackRock. It is to talk a little bit about how your non-traditional path to becoming the CFO and the kind of route you've taken through BlackRock and others have also taken and has prepared you to, with this team, be the next generation.
Thank you for the carefully scripted question. I appreciate it. Listen, I started my career at a law firm, and I was sort of like the inadvertent lawyer. We were talking a little bit backstage. You knew that you wanted to be a journalist when you basically exited the womb. I had no idea what I wanted to do in life. I'm still not quite sure. But I went to law school, and then I worked as a corporate lawyer. I'm a super proud alumnus of a firm called Davis Polk & Wardwell. And I really enjoyed working at the law firm. I worked in the corporate department on transactions. But when I look back on one of the things I really liked about the law firm was this kind of like very super flat place. There's no CEO. There's a managing partner. There's lots of entrepreneurial, smart people trying to win business, build expertise, go out and compete very hard. And I think it was one of the things that kind of drew me to BlackRock. I didn't know that, but I joined BlackRock in the legal department. I think I was the 9th lawyer. There might be 10,444 lawyers or something today. But I was lawyer number 9. And I liked that the firm felt very flat. I liked that it felt like a partnership. It started as a partnership. It started with 8 partners in a room. And I think it's kept that spirit. And Larry, the management team, everybody's focused on creating that sort of partnerly environment. Yes, Larry is the CEO, but it's more of a managing partner. He's more of a managing partner, I'd say, than somebody who tells you, no, move 4 feet to the right. And he's more concerned, and we as a management team are more concerned with 2 things. The first of which is, transitioning from a founder-led firm to a founder-inspired firm, which is very much on our minds, which is how do you take all of the energy, passion, emotional ownership, expertise, connectivity that the founders had. Like if you're sitting 4 feet from somebody all day long, it's really easy to do that. But if somebody's sitting in Singapore and I'm sitting in New York, like we need to create that connectivity. Larry Fink, has never been the CEO of a $10.2 trillion asset manager. Like that happened today. Like he's never done that before. And so we need to bring that spirit to what we do every single day. And then the second thing is we need to institutionalize, the best practices, the client coverage, the investment performance, the service, the innovation, because we're not trying to plan for, what happens over the next 5 years. We're trying to plan for what happens over the next 35 years. And I don't think it's not my job. It's not my partner's job to pick the next CEO. Like that's the board of directors' job. The job that we have is to make sure that we are on this 10-3-1 cycle that I'm talking about, thinking 10 years out, making a strategy for 3 years about how we get there and hitting our 1-year budget. Like that 10-3-1, that's our job. That founder-led to founder-inspired, that's our job. But what I really like about it is our main goal is to try to replicate what felt to me like that law firm world that I lived in that was pretty flat. We had a managing partner to sort of direct a lot of stuff day to day, but we had this highly collaborative, one firm culture. Bring the tax expert, bring the M&A person, bring the credit person, bring the trust and estates person. Like that's how we work at One BlackRock today. Bring the fixed income, bring the equities, bring the public, bring the private, bring the technology, bring the client service, the contracting expert. and deliver it all, to the client in a turnkey bundle of services as a platform that allows them to grow with us. And I find that really exciting.